Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Cash Flow Statement Analysis, a practical guide for better financial decisions. Understanding your cash flow statement isn't just good practice, it's essential. It's how you know if money is coming in fast enough to support expenses or investments. For businesses and individuals alike, cash flow analysis provides clarity on financial health, highlighting areas where adjustments can help prevent issues down the road. Whether you're aiming to manage day-to-day operations or plan for growth, digging into the numbers can guide smarter financial decisions. What is a cash flow statement? A cash flow statement is one of the key financial reports used to understand where money is going in a business. It shows the flow of cash into and out of the company over a specific period. Unlike an income statement or balance sheet, it focuses solely on cash, cold, hard cash, making it an essential tool for tracking liquidity. Whether you're running a startup or managing finances for a well-established business, this document gives you a clear picture of cash-related activities and helps pinpoint the health of your financial operations. Components of the cash flow statement. A cash flow statement is broken into 3 main sections, each highlighting specific activities that affect cash. These categories simplify how you track and manage your cash movement. Operating activities. This section captures cash generated or spent during regular business operations. It includes everyday transactions like selling goods, paying employees, and covering utility bills. For example, income from sales or services provided. Payments made for inventory. Taxes, rent, and other operating expenses. Investing activities. Investing activities focus on cash spent or earned from long-term investments. This could include purchasing equipment, selling assets, or acquiring another company. Examples include cash paid for new machinery, proceeds from selling unused property, investments in securities, financing activities. The financing section reflects money gained or used to fund the business. It typically relates to borrowing or repaying loans, issuing shares, or paying dividends. Here's what you might see: proceeds from a business loan, payments made to reduce debt, dividends distributed to shareholders. Purpose of cash flow statement. Why does every business, big or small, need a cash flow statement? The answer is simple: without it, you're in the dark about your cash position. Consider these essential reasons. Understanding liquidity status. It helps you see if you have enough cash to cover immediate obligations. Can you pay suppliers on time? Do you have room to pay for unexpected costs? Tracking cash trends. By analyzing cash flow over time, businesses can identify patterns. For instance, are you constantly short on cash at month's end? Or is a certain project draining resources? Attracting investors and lenders. Investors and banks want to see how well you're managing cash before providing financing. A strong cash flow statement can build trust and credibility. Improving financial strategy. A detailed cash flow statement helps decision-making. Should you hold off on a big purchase? Is now the time to take out a loan? This report lays out the facts so you can make informed choices. In short, cash flow statements are like a financial pulse check. They keep you grounded in reality, showing exactly what's happening with your money. The importance of cash flow analysis. Cash flow analysis is more than just crunching numbers. It's about understanding how money moves in and out of a business. It offers critical insights into whether a company can sustain itself, grow, or weather unexpected challenges. By taking a closer look at cash flow, business owners, investors, and managers can make informed decisions and avoid financial surprises. Liquidity assessment. Liquidity is a business's ability to meet short-term obligations, and cash flow analysis is one of the best tools for evaluating it. Unlike profits, which can exist on paper without actual cash in hand, liquidity is about real, usable money. When you analyze cash flow, you can see if there's enough cash available to cover immediate needs like payroll, supplier payments, or rent. If cash is consistently tight, it may indicate that the business is overly reliant on credit or delayed receivables. For example, Are customers taking too long to pay their invoices? Is the company spending more on inventory than it can sell within a reasonable time? These insights allow businesses to act quickly, such as tightening credit terms or streamlining expenses. It's like checking your bank balance before a big purchase, it keeps you from overcommitting. Operational efficiency. Cash flow analysis doesn't just show how much money a business has, it reveals how efficiently that money is being used. Positive cash flow from operating activities is often a sign of a well-run business. On the other hand, if cash flow is consistently negative despite high revenues, it could point to inefficiencies or excessive spending. Through analysis, you can identify patterns, such as increased production costs not leading to higher sales. Recurring overdrafts are the need to borrow for routine expenses. Think of it as inspecting a car. The cash flow statement is the engine, and any sputtering could mean deeper issues. Maybe operations are running smoothly, or perhaps there's a problem, like too much money tied up in unsold inventory. By pinpointing areas where cash flow isn't aligned with operational goals, businesses can implement changes, like renegotiating supplier terms or optimizing production cycles. Ultimately, this ensures every dollar is working effectively to drive the company forward. Analyzing cash flow from operating activities. Cash flow from operating activities shows how much cash a business generates from its core operations. This section of the cash flow statement is key for understanding whether regular business activities are sustainable and profitable. It's not about investments or loans, it's about the money your business makes and spends in its day-to-day work. Direct versus indirect methods. Compare the two methods of reporting cash flow from operating activities. There are two methods for reporting operating cash flow, the direct method and the indirect method. Both arrive at the same bottom line figure, but they take different paths to get there. Let's break them down. Direct method. This method provides a simple list of cash inflows and outflows. It starts with all the cash received, like payments from customers, and subtracts all the cash spent, wages, rent, utilities, etc. Picture it as a checkbook register where each transaction is recorded. Advantages. Easy to understand since it focuses only on actual cash receipts and payments. Gives a clearer view of where cash is coming from and where it's going. Takes more time and effort to prepare because it requires tracking every cash transaction. Indirect method. This approach starts with net income from the income statement and adjusts it for non-cash items and changes in working capital. Instead of listing every cash movement, it focuses on reconciling net income with actual cash flow. Advantages. Easier and quicker to prepare because most businesses already track net income. Helps tie together the income statement and cash flow statement. Less transparent, since adjustments can obscure the actual cash movements. In practice, most companies use the indirect method because it's simpler. But if you want deeper insights into operational cash flow, the direct method can provide valuable clarity. Key metrics to consider. Metrics like cash flow margin and operating cash flow ratio. Analyzing operating cash flow isn't just about looking at raw numbers. To truly understand performance, focus on a few critical metrics that put the data into context. Cash flow margin. This metric shows how much cash a company generates from its revenue. It's calculated as operating cash flow divided by net sales. A higher percentage means the business is converting more of its revenue into cash. For example, if your cash flow margin is 20%, that means for every dollar of sales, you're keeping 20 cents in cash. This is key for industries like retail or manufacturing, where cash flow directly impacts day-to-day operations. Operating cash flow ratio. This ratio measures whether your operating activities generate enough cash to cover current liabilities, short-term debts. Use this formula. Operating cash flow divided by current liabilities. A ratio greater than 1 indicates you're in a strong position to pay off short-term obligations. If it's consistently below 1, it's a red flag. You may be relying too heavily on credit or external funding to stay afloat. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.